Well, it's probably at the point when they realize that the euro is the cause of a lot of their economic problems, and those economic problems are getting so bad that they are willing to vote for short-term pain to get out. Or we can continue and be stuck with a system that relies on borrowing more but can't. So at that point, their incentive is to leave and to say goodbye and to say this is a stupid system and that's why we're not going to repay our debt to you.
All right. Hello, Nick. Great to have you here. First, will the euro die?
Yeah, it will die eventually. It's only a question of when. Pretty much all common currencies throughout history have eventually died in terrible circumstances. And it would be quite a surprise, I think, if you look back through history, if the euro did survive. Keep in mind as well that it's not the first time that the euro has been tried and the previous attempts have failed.
Interesting. And how will it happen?
Well, that's the big matter of debate. As far as I'm concerned, the euro doesn't make any economic sense. And its creators understood that. Even the chief economist of the European Central Bank, when it was created, he understood very well. And he told the politicians that this wasn't going to work. It wasn't going to function. And they were doing things backwards. They were creating a currency first and a political union second instead of the other way around. And you just can't do that. And that's why, historically speaking, common currencies like the euro failed. But given that it's a political project that doesn't make economic sense, the question really is, when does the political will run out to keep the euro going? And I think that is a question of economics, because at what point do people vote for a government that will actually leave? Well, it's probably at the point when they realize that the euro is the cause of a lot of their economic problems, and those economic problems are getting so bad that they are willing to vote for short-term pain to get out in order to return to longer-term stability.
Interesting. So you're talking about basically that the Eurozone is basically a political tool. How is that different from the US? I mean, the US has different states and whatnot, and they are a little bit different from each other. Like, why is the Eurozone so different from the US?
Yeah, so I recommend there's a book by Dominic Frisby. It's called, it's about taxation. I've forgotten the title. I think it's in a box behind me in the cupboard. But it's a book about taxes, and part of it is about the history of the US and the history of the US Civil War. And a key part of the US Civil War is the idea that the South was subsidizing the North, right? And they were no longer willing to do so anymore, which sounds pretty familiar, right? It's just with the North and the South reversed. So
wait, the Americans don't like taxes? I thought Americans love taxes.
Yeah.
I'm joking. America started because
there's some other things going on there as well. But I highly recommend Dominic Frisby's book about this situation. So I would say that I'm not so sure it did work in the US, and it took quite a dramatic war in order to enforce the North's control of the South and the North's ability to tax the South. In fact, the war started over a tax issue, specifically a customs collection issue. So there's that. But it's a really good point. Still, the US has a federal government that does its taxation on a federal level, right? And the Eurozone doesn't have that same system. The fact that there is very different parts of the US with very different economies, just like different parts of Europe, different economies, that's a really important point. But I mean, the Federal Reserve System, it has a whole bunch of different branches in a whole bunch of different parts of the US. And that's for a reason. It's because there is this pressure. Another key issue is the cultural and language differences. So people can move within the US very freely and easily to get jobs in different parts, to collect welfare in different parts. They can move across state lines very easily. In Europe, it's a lot more difficult. Freedom of movement has not changed the fact that cultures are very different, languages are different. There's no single body of law. For example, the banking systems are extraordinarily different. The labor systems are different. So all those differences still exist. A lot of people would say the cultural identity is the crucial difference. I'm not so sure about that. I grew up going to international schools inside Europe. I'm comfortable with the idea of a unified Europe, but I think a lot of people aren't. And all of this amounts to just too many issues that just cause conflict within Europe if they share a currency. However, I will definitely accept that the US is the best example against my argument that a common currency can work for a long period of time if you follow up with what would amount to a federal Europe, a United States of Europe. And the question is whether people would want that. And I doubt they would, which is why I think they're more likely to end up leaving the euro.
Interesting. So also, uh, it seems that there's a little bit of difference, right, economically between I mean, there are many differences, between the US and Europe. One of them is that, the US is aligned a little bit more politically. There is one language, as you mentioned, but also economically, states don't have as much debt in terms of GDP, right, compared to Europe. Europe, like each country in its own GDP, like has a lot more debt. So if you look at Italy or Greece, does that play a role as well, or is it more, as you mentioned, like the differences are more cultural, and that can cause, a big breakage?
Yeah, it's a really important point. So first of all, I'd like to mention a counter argument to what you just said, which is that the Eurozone level or the EU level doesn't have a huge amount of debt, whereas the US federal government does. So that sort of cancels it out. But the key point in the US is and Europe is that the differences in the different levels of debt. So the American states, the differences between them are not as great as in the Eurozone. And so because of that, when the one monetary policy is applied, it has less divergent effects. So for example, if the ECB raises interest rates by 1% tomorrow, that has a completely different effect across the different parts of the Eurozone economy, whereas 1% interest rate increase at the Federal Reserve is not going to have as much of a hugely different effect across the United States. And that's one of the key issues is when the European Central Bank sets monetary policy, it's setting one policy for all these different countries that are all completely different in different parts of the economic cycle, facing different economic conditions, different legal positions, everything's different. And when that happens, they set the monetary policy in the awkward in between. So it's too low for Germany and too high for Italy, or whatever the combination is. And that means there's divergence over time. And it's quite easy to explain to people why this is a bad idea. I asked my Japanese father-in-law, well, do you want to have a Chinese monetary policy in Japan? Obviously you don't. You say to Australians, would you like to have the UK's monetary policy in Australia? No, it's a stupid idea. Would the people in the UK want the monetary policy of Canada? No, it's a stupid idea because the UK is different. Well, all these countries in Europe are sharing monetary policy that doesn't apply to their country. It doesn't fit to their country. And everyone understands why that would be a bad idea for Japan or Australia or the UK. But for some reason, they think it's a good idea for Germany to have the same monetary policy as Greece. It's not.
Interesting. But Europe countries are so close to each other. I'm playing the devil's advocate here. What's so different, between Greece and Germany?
Yeah, completely different legal systems, financial systems, economic systems, culturally, language. They are different. There's a reason why common currencies throughout history have failed, because different countries are different. That's why the key point of the first chief economist of the European Central Bank was that the euro should have been launched after the European Union to become like a federal government like in the US, and not before, because the euro would create divergence instead of convergence, as its proponents claimed. It would cause bigger booms and bigger busts. So the classic example of this is that between 2003 and 2008, in Germany, and part of this period I was living in Germany as a child, they had a continuous recession, but the European Central Bank wasn't lowering interest rates because it was worried about a huge economic boom that was happening in places like Ireland and Spain and Greece. And then after the financial crisis, that reversed, where the central bank kept rates very, very low, the European Central Bank, which caused a housing bubble to form in Germany after the financial crisis. And it left Greece and Ireland and Portugal and Italy stuck in recession because their interest rates were too high for them. So the roles reversed perfectly, right? Italy's actually just been rolling along the bottom the whole time. But for most of the Eurozone, the roles reversed. And the game began again. The same housing bubble that had been inflated in Ireland and Spain because of excessively low interest rates for Germany that was in recession, those roles were reversed. The interest rates were too low because of recessions in places like Italy and Spain and Ireland. And so they had a housing bubble in Germany instead. This is the exacerbation of the business cycle and divergence over time between the economies because they're so different, because they've got different housing markets, different populations. Yeah, the whole... Just as Australia and the UK is different, Germany and Greece are different. You shouldn't be applying the same monetary policy.
Interesting. So that reminds me of, a speech that Mario Draghi gave, I think in 2011. I think the Greece was in deep trouble, and their bonds had much higher risk compared to German bonds. And in that statement, he basically mentioned that the Eurozone will do anything, to save the Eurozone. Can the ECB do everything and anything to save the Eurozone? Can this keep going? And why does the dance must stop?
Yeah, so they can. The key price was always going to be the inflation, which has now started. Right. So one of the reasons the financial markets have collapsed so badly this year is because this time around, it's not clear whether the European Central Bank and its other similar central banks around the world can do whatever it takes, given that inflation is already so high. Could they print huge amounts of money and finance governments when inflation is above their mandate? That's not really clear. Before the whole inflation story, it wasn't really clear whether the European Central Bank's actions were technically legal. And I think it was Christine Lagarde who made it very clear that they broke the rules. All the treaties specified no financing of deficits by the European Central Bank, and that's what the European Central Bank did. Now, there comes a point when saying to politicians, but that's illegal, is a bit strange because they write the laws. You're not really getting anywhere by saying to the person who can change the law, well, this is illegal. We'll just change the law. We don't care. So, I mean, the key issue is whether the Germans, probably more politically than legally, will accept what's going on. Perhaps it might take a referendum and so on and so forth. But I think it's possible for them to push it. But in the end, common currencies historically in Europe have always failed because Italy and Greece couldn't keep their deficits under control. There's been lots of common currencies in the European area going back a very long time, and they all failed because of Italy and Greece not controlling deficits. So at some point, that's going to be the key issue, and the Germans are not going to be willing to trash their own currency in order to save the Italians and the Greek welfare state. The question is how that then plays out thereafter. So a lot of people say, well, will Germany leave or will Italy or Greece leave? I don't think that's the right way to frame the question because it's sort of neither here nor there whether Germany makes it so difficult for Italy to remain in the euro that Italy leaves, or Italy decides, unless the Germans give us money, we're leaving. Who's forcing who out doesn't really change the fact that the Eurozone crumbles and the euro as we know it ends. And historically, that's what happened. The core part of the common currency that was in Europe sort of becomes a Deutschmark zone, as it was called one of these times that it happened. The countries that are fiscally responsible can remain in a common currency. And eventually they figure out that it's not a great idea, just as lots of countries around the world don't just borrow monetary policy and currencies off another country unless they can't govern themselves properly. So the model, the way this breaks down historically is quite clear, and there's a reason why it breaks down that way historically. And those are the political incentives which are born in economics because people just don't want to put up with the misery of a common currency.
Interesting. Can you explain a little bit more what's going on? So you mentioned, Germany may have more, political problems compared to other countries because, they're feeling inflation, they're feeling, the pain of being the Eurozone. How does it work inside Europe? What's the target two and how is that working and why that would cause inflation, in the long run?
Yeah, I think that the target two issue is separate to the inflation issue. The target two, that it's really difficult to explain it because it doesn't make any sense, right? Mm-hmm. But the way to think about this is first to understand that when you don't have a common currency mm-hmm. and there's a trade imbalance between two nations, what happens over time is that the trade surplus nation gains assets in the trade deficit nation. So if the Germans sell cars to Greeks, and they get money. Well, they can't use the drachma in Germany. So what they're really doing is gaining ownership of Greek assets. So the Greeks get cars, German cars, and the Germans get assets in Greece. It might be just bank deposits, or it might be property, or whatever it is. And so the Germans get rewards. They gain something in exchange for selling more cars to Italy than Greece sells olive oil to Germany. That trade imbalance builds up as an asset over time for the Germans. But when you share a common currency, things start to go really weird, because what do the Germans get when they sell more cars to the Greeks than the Greeks sell olive oil to Germany? What do they gain? And the answer is target 2 balances. And nobody really knows what that is. And there was a big disagreement about it by all of the people within the establishment, within the system, about what target 2 balances are. But one way to think about them is that the Germans are getting like an account that says the Greeks owe the Germans this much of a trade surplus. The problem is that under the euro, that's unlikely to ever reverse. The Greeks are very unlikely to sell more olive oil to Germany than Germany's going to sell cars to Greece. If that did happen, then the target 2 balance would come back down and it would all balance out and work very well. But it's just not going to happen, especially because the Greeks can't devalue their currency because they're both stuck on the euro. And so what this ends up amounting to is the fact that the Germans are giving the Greeks loads of cars and not getting much olive oil back. And so at some point they're going to wonder, well, why are we doing this? What target 2, but we can't spend target 2 balances. We can't sell them. We can't get anything out of these target 2 balances. What's the point? So I think there's a push within Germany to realize this, to become aware of this. And another good way of expressing is that historically speaking, when the Germans had their own currency, it was a very strong currency. The Deutschmark was very strong. And as a result of Germany's trade surpluses over time, that currency would get even stronger. And that's what allowed Germans to go on holiday throughout Southern Europe. And it was very cheap too, because the Southern European countries had to keep on devaluing their currency. And that gave the Germans something of value, a very strong currency to spend in Southern Europe. And at the moment, there's no similar gain or benefit from the German trade surplus with the rest of Europe that's playing out. So one of the key benefits is no longer accruing to Germany for the strength of its economy. That's the best way to explain target 2 balances. There's lots of other issues with it, including capital flight and things like that. But the point is that the target 2 balances have grown over time, meaning the imbalances inside the Eurozone when it comes to trade and financial flows have been growing over time. And that's a sign that the euro is not sustainable, because eventually those balances are going to just become too great to be no longer noticed.
Interesting. So that seems like some sort of debt, right? Is just another name for debt.
Yeah. So one way of describing it is as a debt, because the Greeks effectively owe the Germans a whole bunch of Greek exports, a whole bunch of olive oil, but they never have to pay it. So is it really a debt? I mean, and the Germans can't call in that debt. They can't say, right, you need to send us a whole bunch of olive oil or we'll stop sending you cars. They can't do that. There's no legal mechanism for them to do that. So all of this actually played out in the USSR, in the Soviet Union, which had a surprisingly similar system. And they had a transfer ruble, which was like the target 2 system, where different economies within the economic system, they built up these trade imbalances. But instead of ever paying in terms of, say, gold or ever settling their trade imbalances, they just kept on growing and growing and growing. And when countries started to leave the Soviet Union, well, they just defaulted on them. So in the end, when all the scores were settled as countries left this system, the Russians had sent a huge amount of goods into the rest of the Soviet Union and had never gained anything back. They'd never gotten anything back for them.
So it seems that there is this underlying that system that it's growing over time, right? It's growing a ton over time. But also each country has different policies in terms of how much that the government takes, right? Like Italy and Greece have a lot of that as percentage of GDP, and that's causing the bonds for different countries to have different risk profiles. But the ECB is buying Greek bonds, so it seems that the ECB is basically incentivizing these countries to keep increasing their debt, because there's no incentive of otherwise. And if you're a politician, why would you spend less and not more? Is that, the root cause of inflation? Basically, they're printing out money and buying that, and that's where, some of these imbalances come.
Yeah, there's a good book by Philip Baggis called Tragedy of the Euro, and it's a play on the word tragedy of the commons, which is an economic theory that if we all own something together, then none of us has an incentive to take care of it. We all have an incentive to basically abuse it, try and get as much of it for our own personal benefit as we can. So whenever groups of people share something, that something tends to not be very well taken care of, and people try and make the most of it. And the euro is the same. A whole bunch of countries share this currency, but they can abuse it by borrowing too much and relying on everyone else to bail them out. Right. And that's basically what's going on inside the Eurozone. When the euro was created, the people who created it put a whole bunch of legal restrictions in place precisely to avoid this issue. And there were lots of promises made, especially to the Germans who were worried about all of this, with reassurances about why this could not happen, how the legal system would prevent it from ever happening. And over time, those have sort of fallen away slowly, or they've been ignored, or the German constitutional courts not enforced them properly, in my view. So that's been weakened. But things are getting a bit ridiculous right now. They're really pushing things, and maybe the German Constitutional Court will at some point say, "No, this is it. We've had enough." The whole structure of the euro was created to avoid this particular situation, and you're simply ignoring it. It's worth mentioning that Christine Lagarde was criminally convicted of financial negligence for her time as the French finance minister. And then she went on to the IMF and admitted, I think it was her at the IMF, that all the rules were ignored for the Eurozone. And now she's head of the European Central Bank. So, if you're going to find someone in the world to break all these rules, it would be her. And maybe that's why she was chosen. So I think the absurdity is growing. And I think that's what a lot of people don't understand about the situation, is that every time until now, Europe has consolidated or managed to fight a crisis successfully. And they see that as a sign of strength, of growing strength. But what if it's a sign that at some point this is just going too far, and the absurdity is increasing, and the ridiculousness is no longer, you can't avoid it anymore. And at some point, then that does end, and if it can't go on forever, then it must end, and it will end. And that's what happened with common currencies like the euro all around the world. I think there's like more than 60 of them, historically speaking, over the last 100 years alone, and they've all failed but one. So,
yeah, I think what's happening in the world right now, it's all there. Everyone is playing the same dance, and you see in Japan with the BOJ. I think they're a little bit ahead, of everyone else. They're implementing yield curve controls, and now you have Europe with the anti-fragmentation tools, and the ECB now is, we're going to talk about this, is buying long-term bonds, it seems. And then eventually the US is going to implement yield curve controls, because, the recession will get so bad that, you have to control it. But it feels that we're playing cycles, and this is a broken system because it's not backed by gold, or I'm a crypto person. I love Bitcoin, so I think that's the solution, but maybe I'm looking for the hammer. But anyway, you were talking about the fact that, they told the Germans that, this wasn't going to happen, and it happened. But one thing to think about, when we're thinking about, okay, this Eurozone is not working, is the fact that, Italy and Greece, they get a benefit from it, right? What's the incentive for them to leave? And on the other side, you have Germany that's within this target 2 is on so much money that, to break the zone would be bad for them, right? There is a saying that, if you own the bank $100, the bank you own the bank $100, it's your problem, right? But if you own the bank $1 million or $100 million, it's the bank's problem. It's not your problem. So
that's a fair comment. But then where does that leave the Germans, especially with double-digit inflation approaching? So I think pressure to resist Italy and Greece's ability to abuse the euro does then start to matter, and they'll start to impose conditions. And we've seen that with the latest round of the ECB's policies, where Italy will have to comply with the EU's fiscal rules in order to access the European Central Bank's emergency measures. Now, that's completely meaningless story as far as I'm concerned, because the ECB will just launch a new program that doesn't have those constraints if there's a bond crisis in Italy. So, yes, Italy does receive, and Greece receive, a benefit from the euro. But I'm not so sure that's entirely clear, especially to the typical Greek and Italian voter. These systems, political, economic, financial, in Italy and Greece, they're reliant and they're built on devaluation of the currency. Right. Now, there's lots of different ways you can deal with various economic and financial problems. Devaluing your currency is one of them. That's the Italian and the Greek way. The German way is fiscal reform and welfare reform, and falling prices and so on and so forth. And I was there when that was imposed in Germany in 2003 and 4, I think it was. 2002. But anyway, so there's different ways of dealing with this. And the Italian and the Greek way is established. It's devaluation. They want their currency to be the part of the economic system that gives way, that's the pressure valve for the pressure that's building up. And I think they will try and return to that at some point. Italy may be benefiting from the euro in the sense that its currency is now stable, but its economy has been an unparalleled disaster. If you look at GDP growth and things like that, and unemployment measures in some parts of Southern Europe, and there's also the fiscal instability. Now, what if the benefit that is supposedly accrued to Greece and Italy is really only there because they've been able to borrow huge amounts of money over huge amounts of time with the implicit backing of the Germans, but at some point that has to end. At some point, Italy cannot borrow more money, right? And then they're not just going to have to deal with the fact that they can't borrow any more money. They're going to have to deal with the fact that they borrowed the amount that they already have. They've got to deal with the existing debt pile. And then they can do two things. They can say, well, we can leave the euro and just never repay. Or we can continue and be stuck with a system that relies on borrowing more but can't. So at that point, their incentive is to leave and to say goodbye and to say this is a stupid system and that's why we're not going to repay our debt to you. We're going to leave and we're going to devalue you. And we're going to get our way out of it that way. And you've got to remember, that's the way that lots of other countries around the world deal with it. Australia didn't even have a recession in 2008 because the Australian dollar absolutely crashed. After the Brexit referendum, the pound crashed and the economy did just fine as a result. Foreign direct investment went absolutely record bananas, huge levels because the pound crashed. So this mechanism of a falling currency is really important to allow an economy to rebalance. And the Italians and the Greeks, who rely on it disproportionately, historically speaking, have been denied that. They cannot devalue their currency, especially against their key trading partners, which is one of the ironies of the euro. So, I mean, there's a reason why we'd stop pegging currencies around the world. There's a reason why the Australian dollar is not pegged to the pound, because it's a bad policy and it takes away one of the most important rebalancing mechanisms of an economy, the fact that the currency can fall in order to rebalance things.
Talk about artificial intelligence. The car that you drive, the news that you see, and movies you watch are all influenced by artificial intelligence algorithms. They're programming our minds and our societies. Everyone from journalists to investors sees the growing impact of AI in our lives, but few know what's under the hood. Have you ever wondered how machine learning algorithms work, how they arise, and where they are going? In the book, Making Things Think, I answer these questions and go over a detailed yet approachable explanation for the intelligent reader. The link for the book is down in the show notes. Thank you, and let's keep the interview rolling. Interesting. So you mentioned as well that Italy has had economic problems. Is that tied to the fact that they are in the Eurozone, or is that completely separate?
But it's both. I mean, not having your own government is bad, but I do accept the argument that Italy is better governed, or Greece is better governed inside the Eurozone and the EU, both monetarily and fiscally. I think that's clear, but the question is whether they want to return to their ability to devalue in order to solve their problems. Interesting.
So I mean, you laid out really well how the Eurozone will break apart, and then that begs the question: when will it happen? And in some ways, it might not be in an exact time like, it won't be 2027, but it might be a period of time, right? Is the UK leaving the Eurozone part, already? Did the Eurozone start breaking apart already and we're in the middle of it? Or are we, or is it going to be, in a few years from now? Like, what's your opinion on that?
Yeah, I think the Brexit story has proven that it's possible to leave the EU. I think leaving the Eurozone is going to be a lot more difficult. I think the financial and economic ties and the fact that the debt's denominated in euros is going to be a lot more difficult. But the fact that none of the horrific predictions about Brexit played out is an important sign. It's also, from Brexit, an important sign that, it took 4 years, 3.5 years from the point of the referendum to actually leave. And there was a whole bunch of processes on the way along the way there, and all sorts of different things changed along the way, which obfuscated the whole process. So the actual terms and the way Italy and Greece leave it, is completely up for grabs, and the consequences and the timing as well. If you look at what's happened in Italian politics over the last few years, Matteo Salvini from Lega went from saying that the euro was a crime against humanity to being pro-euro almost. And as a result, his dominance of Italian politics was absolutely crushed at the recent elections, and that his voters effectively went further to the right. I think that's a pretty big sign that the Italian voter really does want to take on the EU and the euro's establishment, and possibly even leave. And I think that Salvini made a big mistake by abandoning those promises. And the same goes for Five Star on the left, almost exactly the same story. So the desire is there. You've also got to remember that referendums, the euro was rejected. I'd accept that there's got to be some sort of crisis that's so severe that leaving the euro looks like a solution, and that we've got to wait for that crisis to occur first, especially in order to create the political will. But again, historically speaking, these things eventually happen to all these common currencies, and they break apart. I can't see will for integration for full federal, the United States of Europe. I can't see the will for that, and I think I can see the will for a breakup. But the point is that the awkward in between doesn't work. And all the financial economic conditions of staying with an awkward in between are growing worse and worse and worse. The target 2 balances are growing, the debt levels are growing, the interest rates, all these problems are growing worse and worse and worse. And at some point, something's got to give.
Interesting. So going back to how things are playing out right now, and how for example in Italy there was a politician that was just voted, and she's very against, she's very pro-Italy, let's say. And like what's happening right now, I believe that, this crisis won't be the crisis that, breaks it apart. But what's happening right now, like is the inflation going to be really high now in the winter? Like, how is the economy right now in Europe?
Yeah, it's a ginormous mess, and it's very difficult to keep track of. I think one of the big issues here is the weather this winter is this huge unknown variable that has a huge impact on what does happen next. But I'm a lot more worried about next year, actually. Right now, what the Europeans are doing is they're shutting down their industry, their economy, in order to keep enough energy. Which is a strange way of doing things, really, because really the energy is there for the economy. So shutting down the economy for energy is a bit backwards. But the problem is that has flow-on effects to next year. So, for example, making fertilizer is very energy intensive. So if you start shutting down energy, we don't have enough energy, and you start shutting down the industrial processes, then next year you're not going to have enough fertilizer. And the spring planting season that gives the food for the year is going to come up short. Lots of Dutch greenhouses rely on high energy use. They're shutting down. So there's going to be, I think, food shortages next year. The Eurozone, generally speaking, is a lot wealthier than most parts of the world, which means it can buy up the world's resources. So I think a lot of the crisis might not be felt inside Europe, apart from the fact that it's higher prices, but the actual shortages that they're causing in Europe might actually show up around Europe, in the Middle East, for example, or Eastern Europe. And so while the Europeans are struggling with high prices because they're having to outbid the rest of the world to get enough food and energy and resources to get through the year, it's the rest of the world that's going to be left without those resources. There's lots of news reports about Germany, and I've forgotten today's one. Somebody announced, I think it was actually Italy. Italy announced that it had secured enough gas to get through winter. Well, who's going without the gas then? Whose gas have they managed to buy at these high prices that only Italy and other European countries can afford? So I think this year's and especially winter's an energy crisis. But next year we're going to realize that energy is the lifeblood of everything else. And so the rest of the economy starts to struggle. And the big irony underlying all of this is that the reason there's so much focus on energy is because of inflation. Because high energy prices cause high inflation. Well, if you shut down the industrial capacity of the economy, that's going to cause a huge shortage in goods other than energy. So all you've done is shifted the inflationary problem from energy to other goods. Aluminium's a good example, fertilizer, as I explained. So they've shifted the inflationary problem around into a different sector of the economy, but it's just still going to be there, and it hasn't solved the whole problem. So I think there's definitely a high potential for this to actually get worse next year, or if not worse, to stay at such a bad level that the amount of time it's remaining at that high level becomes the key issue, and more of Europe is basically forced to deindustrialize and shut down, and these shortages grow even worse.
Interesting. Yeah, it's kind of interesting and funny because in the US, we saw the same pattern, the US spending so much money, and because the US has so much influence and it's like a big part of the economy, Japan was doing the same. We end up seeing inflation everywhere, and not only in the US, some countries less so than the US. But at the time, I was a little bit upset. I didn't mention to many people. Like, some people were saying, "Oh no, it's fine. In the U.S. it's gonna be fine." But like, the poor countries are the ones that suffer the most whenever you have inflation and the economy is suffering. It's like the poorest are the ones that suffer the most, and it's kind of annoying to me. But anyway,
the IMF bailouts for this year are at record levels, which is not really in the news very much. And the question is, who's needing assistance and rescues? And as you say, all of these poorer countries, Sri Lanka is a textbook example at the moment. Meanwhile, places like Brazil and Russia are doing quite well because they have those resources that the world is short on. I think the ruble's up like 27% this year. The Brazilian real is up a lot too. I think they're the only two currencies that are up against the US dollar. So Australia's a mixed bag, so let's not go there. But yeah, there's these big changes around the world where countries that are considered emerging markets have been divided into, and some of them are the worst performers that are struggling the most, and some of them are doing just fine.
Brazil is a commodity exporter, and that helps a ton. But like Brazil, I know a little bit more close. Like economically, it has been doing well in the past few years. Russia, from what I study, even though they're political problems and whatnot, they manage their economy really well, and the reason why they're invading is because they knew politically was the right time to do it. But yeah, I mean, it's a cynical view, but for me it seems that economically they knew that was the right time, and politically as well. But yeah, going back to Europe, so it seems that inflation is skyrocketing, and it's not only going to be this year with energy prices, but eventually we'll have food prices and whatnot. Inflation will show up, but also they are seeing a lot of other problems with their debt, and like the dollar is valuing against all these currencies. At the same time, like it seems that there's a liquidity problem going on. Like it seems that Europe is a big mess. And there is this tool that was applied recently called the Anti-fragmentation tool. Can you talk a little bit more about it and how that intertwines with what's going on?
Yeah, so the Germans keep on complaining about the European Central Bank's latest mechanism and whether it's legal to bail out all these countries through the back door, and why these different programs are violating the various rules that the European Central Bank was set up with. And the latest one is the one you mentioned. And one of the key parts of that is that the country that is trying to get rescued by the European Central Bank, where they effectively create money and buy bonds, must comply with the European Commission's budget rules. So they have to control the deficits and so on and so forth. And this is going to become one of the key issues over the next few months between the new Italian government and the ECB and the Eurozone and the EU, whether or not Italy complies enough with the budget rules in order to get access to the anti-fragmentation advice from the ECB. But I still think that's a bit of a red herring, because we've had so many of these programs from the ECB over the last few years now. I don't even remember some of the names. I remember the ESM and the EFSF and so on and so forth. And they just sort of, each time the old program is declared invalid for whatever reason, either legally or because the pandemic's over, whatever it is, just come up with a new one, right? And the European Central Bank has what it considers to be a trump card, which is that they have to be able to conduct monetary policy. So the policy transmission mechanism has to function. And because they conduct monetary policy through government bond markets, that means government bond markets have to be functioning. And that basically means that they can force government bond markets to function as part of their normal everyday conduct of monetary policy, which basically gives them justification to bail out Greece and Italy, whoever else it might be, and just say, well, look, we're not actually financing governments, we're just conducting everyday monetary policy, and we weren't able to without having to bail out Italy and Greece in the process. So this game where the Germans kid themselves, and I'm German, by the way, the Germans kid themselves by saying there's some sort of legal constraint, and it's finally got to stop. This is they're going to break the rules if they do this. There's no way this going. I don't think that really exists, and that's why I say it's a political problem. It's not an economic problem because we know the euro doesn't make sense. It's not a legal problem because they can change the laws. It's a political problem because at some point someone has to say, we're not doing this anymore. And that's how it was with Brexit too, right? Eventually it had to be a political thing where even the referendum didn't settle things. Eventually you had to get someone that had the mandate, not just the mandate, but was willing to follow the mandate to bring about Brexit. And you've also got to remember that only happened as a result of Nigel Farage putting on enough pressure by the Brexit party. So that political will was enough to not just get the Brexit referendum, but actually to get Brexit over the line, however badly and imperfectly. I think it might be very much the same thing. And that's why the Italian elections are so interesting, with not just the right, but the far right part of the coalition forming governments, and similar story in Sweden, although probably for different issues.
Interesting. Yeah. Trusting politicians to follow the rules or, not lie. It's kind of insane. Yeah. But it's kind of crazy, that like these, countries are so different. They're culturally different. They're so different from each other. It's kind of crazy to try to put them together into a block. Like, why? It just doesn't make any sense. Interesting. So I want to go a little bit, towards the US and how, America has influenced, the whole world. And the dollar, since, 71 became the world reserve currency. And I think we're seeing the end of it somehow, in 2000, before the Iraq war, Saddam Hussein was, trying to sell oil in Russian rubles, but that didn't turn out too well for him. But now, Russia is moving away from the dollar. It was insane. Basically, the US is basically saying that they're not gonna follow their promises with the treasuries. So it seems that, politically, there's a big move towards out of the dollar system that was backed by, U.S. treasuries. And that will have deep implications, into the whole economy. But Europe, is seeing like high inflation, and because the U.S. is rising interest rates, there's a big liquidity problem with the dollar, and the dollar is going up against all these different currencies, and more recently, we see even England having some problems in regards to that, and that may affect, the European economy. Is there, like a movement or, to move some European countries, out of this dollar reserve, moving out of U.S. treasuries, like central banks not buying, as much. China, I think they stopped buying 10 years ago as much U.S. treasuries, and they've been selling. So like, what's going on there, and like how is the U.S. influence over Europe gonna change over the coming 5-10 years?
Too many different topics. I want to write them all down.
Yeah.
One of the big ironies here is that the euro was created to challenge the US dollar's status, right? So that's not going so well. But anyway, the other topic I want to mention is the Chinese acquired these huge foreign reserves and treasuries. Well, how did they do it? Well, they had a trade surplus.
Yeah.
And as I said before, normally when two countries trade and there's a trade surplus, they gain something, gain an asset under the Eurozone system. That doesn't happen. But the Chinese acquired all these treasuries. Now, did it cost them anything to acquire those? No, because they pegged the exchange rate, they printed the money and bought them. Mm-hmm. So in my opinion, the Chinese don't care about those treasuries. If they wanted to, they could just write them off tomorrow and not care. That wouldn't really affect them, because it was just a side effect of their economic policy of the last 2 decades of maintaining a currency peg. So they printed yuan and bought treasuries with their trade surpluses. So I don't think the Chinese are particularly worried about their big holdings of treasuries, and they wouldn't mind if they would, well, they would probably mind, but it wouldn't be a disaster if they defaulted on. It wouldn't be a disaster if the treasury market crashed, which means the Chinese could crash the treasury market on purpose, which is an interesting thing to remember there. There's so many other parts of the question. I usually I work with Jim Ricketts, who's the best person on this particular topic. So in the UK, I work with Nigel Farage, and in Australia, I work with Jim Ricketts, trying to localize his content for Australians who want to figure out how to invest based on Jim Ricketts' views. And one of his key points is there's a big difference between a global reserve currency and a transaction currency. So transaction currency at the moment is also the US dollar. So whenever anyone wants to buy gold or oil or whatever it is, they've got to pay in US dollars, right? So that's the transaction currency side of things. The reserve currency side of things is on central bank balance sheets or those Chinese treasuries. So when someone accumulates reserves, they keep them in US dollars. Those are two separate things sometimes. Usually they're the same thing. But when things start to change with global currencies, such as the pound after World War I, then sometimes it's the transaction currency that moves first. So what's happening is that all these countries around the world are saying, well, why are we using the US dollar to trade with each other? China and Russia trading with each other, they're using US dollars. Well, that's a strange thing to do, really. It does actually make sense, because if everyone's using the same currency, it makes life a lot easier. But when the US is sanctioning different countries and imposing various restraints on them from using the US dollar, then suddenly it doesn't make so much sense to use the US dollar as transaction currency. It's a great example of this. There was I think a German policeman who wanted to buy Cuban cigars from Denmark. That's the other way around. And they transacted in US dollars, and the US Treasury, I believe, froze the transaction under the Cuban embargo rules and took the money. Took the money. So this story with Russia and oil and gas and all these sanctions is not new. It's been going on for a while. The US has controlled the global trade system because everyone's using US dollars. So there's lots of countries that are thinking this is a bad idea. There's lots of commodities exchanges being set up around the world that don't use US dollars and therefore are not within the grasp of the US government's control. So there's an irony here because it looked like the US was extremely powerful and in an extremely powerful position because it controlled the US dollar and everyone was using the US dollar in trade. But as soon as it used that power in any way, everyone sort of woke up and said, well, we need an alternative actually. And I'm sure you'll be hoping they use Bitcoin, but for now, it doesn't look like they will. It looks like they'll be using each other's currencies or gold or whatever it might be. There was a comment from the deputy speaker or someone in the Russian parliament saying, well, if they won't pay in rubles, they can pay in gold, which is real money. So whatever it is that they might use, that transaction side of things is separate to the reserve side. And it's very likely that it signals a change and it signals the very beginning of the demise of the US dollar as a reserve currency. But I think at least for now, the US dollar is, well, as we've seen over the last few months, it's still the best place to keep your capital safe, especially during a crisis, the best rule of law, deepest capital markets, most liquidity, and so on and so forth. So it's the best place to keep your reserves for now, even if it is losing this transaction status, global transaction currency status. And that it's just, I suppose, just yet another example of why we should all be using one currency, whether it's in the Eurozone or globally with the US dollar.
Interesting. But also, I mean, there is, part of the system is the dollars, the transacting layer, but also saving wise, there's the US Treasury, right? Treasuries, which Russia, had a lot of reserves there. And, I think we'll see, but I think that was a big mistake to sanction Russia economically because the US will see eventually, the effects of that. We don't see the effects right now, even though, the war may be horrible or whatnot, but I think in the long run, it might play out to be a bad decision because then countries have incentive to move, not trust the US, with the US treasuries. Is that happening in Europe? Moving away from maybe people are talking about it, or is there no talk about moving away from the US treasuries?
I don't know about Europe, but it's important to note that although I agree with you, it's an extremely dangerous presumption to make as an investor. And 2008 proved why. So you had a crisis inside the US, very isolated inside US mortgages, US subprime mortgages, a small corner of the US mortgage market, nothing to do with Europe. And yet, look at what happened as a result. Europe is in a sovereign debt crisis for many years after the US had already recovered from the 2008 crash. So at that key point when the mortgage bubble burst, the logical thing would have been to escape with your capital from the US. And yet the opposite happened. Money flooded back into the US. The US dollar rallied really hard. US Treasury yields plunged and US bond prices rose, which is a different way of saying the same thing. And so holding US government debt was a really good thing to do, despite the fact that the crisis originated in the US. Now, at some point, that might not happen. But I think it might require an alternative, a viable alternative, before it can happen. I don't know what that might be, but I don't think it exists yet. I definitely don't think it's the euro, but that was the theory for creating the euro. But the point being that the knee-jerk reaction, the reflex reaction towards the US dollar in their crisis, even if it's a US crisis, is still so strong that I think betting on the demise of the dollar in a crisis for all the right reasons is, I don't think the risk-reward ratio is there. We might be waiting for the rest of our lifetimes for something like that to play out. So I'm much more comfortable betting on the demise of the euro.
Yeah, I was talking to Tavi Costa about this, and he was saying, "Oh, look, he was basically arguing that he's bearish in big tech, and I think he has a point, especially this year. This next year, I think the recession will be pretty bad. I think yesterday, just recently, Apple announced that they're not going to produce. They didn't announce it, but it came out that they're not going to. This is slowing down production of iPhones. So I think the recession is hitting big tech. But I think this is just one a hiccup, and one argument that I made is like, what else are you going to invest? Are you going to, like, if China is like, they have a population problem right now. Their economy is like super leveraged. They're not a developed country. The real estate market is crazy. Europe, has high inflation and whatnot. Like, where else are you going to put your money? But I think one interesting aspect that we're seeing, Druckenmiller had this point that, he was talking about, the dollar as world reserve currency. And I think during the CARES Act, we had a huge liquidity problem, with bonds. And it turns out that a lot of the money was getting out of US bonds and whatnot and towards big tech. They were like basically moving the money to tech, right? So it wasn't moving outside of the US, but, the money was moving from, basically giving money to the government, because that's at the end what you're doing, right? To private corporations. And you see, pension funds of like developed nations in Europe, they are investing, in tech companies at the end of the day, in big tech, right? So I wonder if that's the trend, right? Like if we're like trusting a little bit less, the government, because like that to GDP is like increasing more and more, and not like in Europe, you have Target 2, and now you have, these bonds, they're not called bonds, but like they masquerade and whatnot, and in the US you have like that to GDP going up, and it seems that like no politician is willing to do the hard thing, and I don't see how they can. But you still have like a functioning economy underneath, right? So I wonder if that's what's going to happen. But yeah, anyway.
That's a good point. But the issue is that you might be right for the wrong reasons. I think you might be right because of the crash has happened to the extent that it has. So what made this year so unique? And I think, but based on my back of the envelope calculations, that it's the worst year ever for investing in the US with a balanced portfolio. So 60% stocks, 40% bonds. How did you go year to date 2022? Worst ever, going back to the 30s, adjusted for inflation. So it's almost as bad as 1931 and 1937, I believe, but adjusted for inflation, because inflation spiked so much. It's actually the worst year ever. And a huge part of that was the rout in tech stocks. So the big story with investing is everyone focuses on where things are going, but I think they need to focus more on things where things start. You mentioned earlier, there's nowhere good to invest because all these different parts of financial system, they're all crashing. Well, it's because they started out too high. The everything bubble, everything started out the bubble. So the logical thing to do is to invest in the part that's crashed most. Now, property hasn't crashed much yet. Bonds have crashed quite a bit. Tech stocks have crashed a huge amount. The stock market's crashed quite a bit. So I think you might be right for the wrong reasons, in the sense that, that might be the best place to invest right now. Just because, you're not going to make much money anywhere else. Definitely not going to make enough money to offset the inflationary pressures anywhere else. And at least they're productive parts of the economy that have potential. They're growing. They're probably more trustworthy than politicians. They're trying to actually improve the world. Maybe this is a good buying opportunity, or at some point there will be a good buying opportunity. And at that point, you're unlikely to be served well by buying bonds over stocks.
Yeah. It's interesting because there's this line, between a big correlation between big tech and how much QE has been happening, how much, basically at the end of the day, you look at M2 all over the world, and it's like very correlated. Basically, you're printing out money, and like where can it go, right? Especially here in the US. So yeah, I just think the system will keep going. I think it's a problem with the fiat system. But yeah, I may be wrong there. But yeah, I think we're like, this is one really bad crisis, and it's just like the cycle keeps happening, and it's worse and worse and worse every time that it happens, because the bubble is just bigger and bigger. The amount of debt to the GDP is bigger. Like, you know, the yield, what's the name? Interest rates keep going down over time historically since the 70s. Like, and then when you try to break out of the trend line, then something happens, you know. And now we're seeing, you know, like Europe breaking apart, other currencies, the BOJ is like scrambling. But anyway, yeah, I may be wrong there, but I think, yeah, that's what's happening. Cool. Anything you want to add about, you know, the European Union, or yeah?
No, I don't think so. I'm seeing Nigel Farage tomorrow. He's giving a speech to Australians about why they shouldn't follow the net zero pledges, and probably some other things. He usually is a good person to listen to on where the Euro and the European Union is going. He sparked a lot of my interest in these things. I definitely recommend people, if they find this video interesting, have a look at some of what he said very many years ago about the Euro specifically. I wasn't so interested in his UK politics. I was interested in his analysis, and he was a city man and investor. So if you want to see, this is going to be really instructive to see how people perceived that Eurozone crisis playing out, and how people anticipated it, and the reasoning. I think the power of hindsight has a lot of explanatory effect in this story. So that might be the next best place to click after watching this video.
Interesting, yeah. Yeah, one side note, I think Theo has a really good quote about this net zero insanity. He says ESG is equals to CCP. And yeah, it's basically, yeah, it's kind of nuts. Like, yeah, I think it's bad policies, and yeah, we're seeing the effects of it, and hopefully we move away before it gets really bad in terms of energy and whatnot. Thank you so much for taking the time. This was a great conversation. I learned a ton. I hope our viewers also learned a ton from you. It was like really nice, and I hope you enjoy your time with Farage.
Yeah, it was good fun. Thanks for having me. We'll do it again if the Euro dies.
We'll do it. Yeah, I don't think
when.
Yeah, when. Yeah. Perfect.